Hello and welcome to FT Markets here in New York. A big week beckons for markets. The Federal Reserve concludes a two-day policy meeting on Wednesday afternoon, and we are expecting some fireworks. Indeed, over the last week we've seen the two-year Treasury yield hit its highest level since May of 2011, the dollar has gained strength, and inflation expectations have come off quite sharply. Joining me now to discuss what we could expect here for markets and investors is Cardiff Garcia from FT Alphaville. Cardiff.
How are you, Mike?
I'm good. How are things?
Good, man, good. Looking forward to this Wednesday, and I think you're absolutely right. This is not just a pivotal meeting. The range of possible outcomes for this meeting is really, really wide.
It's the ultimate crapshoot, basically.
Yeah, absolutely. And I would draw a dichotomy between most economic indicators, which show a very vital, accelerated pace of the recovery, and the two that matter most, which are around inflation and employment. We've seen that the pace of jobs growth in the last few months has slowed. We've seen that inflation has moderated. And so the chances that some parts of the market are going to be surprised if Janet Yellen decides to punt at this meeting into, say, the October or the December meeting and decides to make the big change to the statement then. Because I think one thing they're worried about is that if they do change the language, that considerable time language that you just discussed, that it'll be misinterpreted as a more hawkish signal than was intended. And we've seen from what's happened with the ECB, the central banks of Australia, Sweden, Norway, they all hiked rates too early and then later had to loosen again, but none of them has the wide sweep of influence that the Fed has. I think the Fed really wants to avoid that outcome.
And when we sort of look at considerable time, this is a key phrase because the market essentially believes that as long as the Fed keeps saying a considerable time, that means rate hikes aren't coming for at least 6 months. So if they do drop it at this month's meeting, that means we could be potentially looking at a rate hike next March. Now the bond market thinks June, perhaps September of next year is a more likely starting date. Why do you think the Fed wants to maybe tweak that language? We have heard some of the more hawkish members of the FOMC recently come out and say it needs to be changed, it needs to go more to a data dependency type model. What's pushing that?
Well, I think one possibility is that as the economy continues to get closer to full employment, that considerable time language is being thought of, correctly so, as a kind of date-based contingent language, instead of what the Fed really wants, which is data contingent language. It wants the start and the pace of tightening to be tied to movements in the economy, in the real economy. And so one reason that even dovish members might want to change the language is precisely for that reason. They want the language, they want the guidance to be tied to incoming data instead of to a calendar date. The problem, again, is that this has a very high risk of being misinterpreted for exactly the reasons you gave. And that's why I think there's a chance. I don't really know. I mean, it's a very uncertain outcome. That's why it's so interesting. But there's a chance that Janet Yellen might decide it's too soon to risk that, and so let's punt it until later on. Who knows? It's going to be fascinating to see.
Yeah, and it's probably more likely to be December because October she doesn't give a press conference.
Exactly.
Like she does in December.
Exactly.
And having spoken to a few people in the bond market, they like this idea that the Fed, if it does change things, they want to see the market reaction, and then Janet Yellen can step up in front of the microphones 45 minutes later and douse down the animal spirits.
Yep.
But I think one thing that got the market, that sort of put the market on notice that the September meeting could be quite, very interesting, was the fact that we had a paper from the San Francisco Fed in which it sort of made the point that everyone knows, and this is not new news, but they just sort of made the point that the bond market is underpricing the Fed's own forecasts. And obviously the worry here amongst perhaps some of the members of the FOMC is that if indeed the economy does start to pick up, then they have to raise rates, and perhaps even raise rates at a faster than expected pace, this could lead to quite a disorderly eruption in the front of the market.
Off guard.
So, I mean, how important do you think that San Fran Fed paper was? Do you think it's a bit of a stalking horse?
I don't know. What's interesting about that San Fran Fed paper, though, is that remember that Janet Yellen said earlier this year to ignore the dots, that it's what's in the actual statement that matters. Well, maybe she got what she asked for, and now the worry is, again, that if this statement, if the new statement gets misinterpreted as a hawkish signal, there's a lot of people out there in the market that are going to be caught flat-footed, and like you said, there might be that unwinding. But there's something else that's also interesting about the upcoming 2017 dot plot, which is that this is the first year's forecast, 2017, where there's going to be considerable overlap, we think, between the Fed's longer-term forecast for interest rates and jobs growth and inflation and the actual placement of the dots, the median placement of the dots. And so I think it's going to be fascinating to see if that gives us any hints, not just about where the Fed thinks that interest rates are going, but about how quickly it intends to tighten once that process really starts.
Great, Cardiff. Well, the markets definitely have a lot to look forward to on Wednesday afternoon, particularly when Janet Yellen starts speaking. Thanks for now.
You got it. Going to be a fun week.